Just a quick disclaimer, anything mentioned in this video is how I invest my own portfolio and is not a recommendation. Always do your own research or consult a qualified professional before making investment decisions. Vanguard's Lifestrategy range is one of their most popular product offerings, and it's actually something I haven't really talked about much on this channel so far. But I'll assume that anyone watching is familiar with this product, and if not, there are plenty of other channels that have done a great job already at walking through this range, so go check one of those out first. I tend to favour a passive global equity index fund approach for my personal investing journey. This strategy is both extremely simple and very difficult to beat. The popular book Investing Demystified by Lars Kroyer explains that markets are efficient and that most people cannot outperform the market or pick a fund manager to outperform the market for them after fees and expenses. Therefore, they'll be better off by becoming a rational investor and adopting a rational portfolio. The rational portfolio consists of two asset classes, an extremely low risk asset like cash or government bonds, and a low cost world equity market index tracker, which is how I invest in the stock market personally, currently favouring a small amount of cash in my Starling Bank current account to cover any immediate expenses, and the FTSE Developed World UCITS ETF, ticker VEVE, to get my global equity exposure. The Global Equity Market Index Tracker is a product that allows you to own global equities based on their market value at an extremely low cost. So why didn't I just choose an appropriate fund from the Vanguard Lifestrategy range and be done with it? Well, the simple answer is the higher cost. The importance of costs. Costs are a very important part of investing. As Jack Bogle says, the grim irony of investing is that we investors, as a group, not only don't get what we pay for, we get precisely what we don't pay for. If we take a hypothetical example of a 25-year-old investor who puts away $500 per month into a global tracker that compounds at 10% per year for 40 years until they are age 65, excluding platform costs as they are often staggered at different thresholds, so it would come down over time. With a 0.12% ongoing charge figure like VEVE, the pot would compound to around $2,706,468. Assuming the same return with just an additional charge of 0.1% like the Lifestrategy 100% Equity Index Fund, which has an OCF of 0.22%. In this hypothetical example, the pot would be reduced to $2,632,741. That's over $73k less due to a seemingly tiny ongoing charge. Maybe the difference in weightings in Vanguard Lifestrategy will perform slightly higher, or maybe slightly worse, who knows? But the thing we know for certain is the cost. I expect the Lifestrategy range and the other popular Vanguard Global Tracker options, like VWRL and the FTSE Global All Cap Funds, costs to come down as they increase in size, but until then, personally, I'll be sticking with VEVE. When I might use the Lifestrategy range. If I was to add bonds to the portfolio, the Lifestrategy range could prove super useful, and I think that's when the ability to access a ready-made off-the-shelf portfolio really comes into its own, and the higher cost is probably justified in my book, as it saves having to do the rebalancing and select which bond funds to include, etc., and takes out the human emotion element to investing. Why none of this actually matters anyway? In the bigger picture of achieving financial independence, none of this really matters anyway. Overweighting to the UK with a Lifestrategy fund versus a market cap weighted global tracker, including or excluding small caps and emerging markets, or maybe even just investing in the US market, like many of the US-based FIRE bloggers suggest. I think these are all discussions trying to find solutions to the wrong questions. The most important driver for achieving FI, especially at the beginning of the journey, is increasing savings rates and getting the compounding machine up and running. If you can increase your income or cut expenses to invest more money each month, this will make a far bigger difference in the long run than obsessing over an extra few percentage points of return here and there. In case you are wondering, doubling the investment amount from $500 to $1,000 in the earlier example would leave you with a pot of over $5.2 million, even with the higher cost fund. Don't get sucked into over-optimizing the portfolio. Instead, focus on the bigger questions, like how you can increase your income, or how you can spend that time in a better way, like starting a business on the side or spending time with friends and family. So there we have it. I hope this was useful. My strategy is a boring and lazy approach to investing, but for me boring and lazy is good. Maybe it has some flaws, sure, that's possible, but I like to keep investing as simple as possible to give me headspace to do other things in life without having to constantly monitor and check my investments.